Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's LONGWave video, as I did last month, I'd like to discuss what we are seeing in our MATA SII charts to put them into an integrated context. As such, I'd like to cover those items listed here. Let's begin this session, as I did last month, with a discussion regarding the intra-market signals. Let's again start with the currency market and specifically the US dollar. As you have seen before, I show here the dollar chart we drew not long after the financial crisis. This elliptical theory chart has turned out to be an extraordinary chart in calling both the bottom in the US dollar and the time frame of its expected rally. You can see it hit our high probability target zones, that is circles located on the right side of the ellipse's ring. We are now, however, at a very critical time regarding the dollar and whether it follows the ellipse higher or trades within the red channel. On a more detailed view, which you can find on the MATA SII site, you will see we have broken outside the ellipse with a significant overhead resistance, not much higher than we are presently trading at. This US dollar chart shows that we appear to be within an ending diagonal pattern, pointing us towards a right shoulder, termination in 2019, before heading lower into the presidential election cycle year. Quantitative tightening and higher rates have been good for the dollar since they were initiated, but both are being reversed since the Fed recently changed policy direction guidance. There appears to be more lift left in the US dollar, likely a flight to safety shock of some sort, whether it's Brexit, a geopolitical event, or whatever, before heading lower. The bond market, as represented by the 10-year U.S. Treasury, is also signaling a possible right shoulder in 2019. This TNX chart of the 10-year Treasury's yield, which we initiated in 2016, has also turned out to be very accurate, and you have seen it many times as it has unfolded. We are not sure we have quite found the bottom in this drop in yields, but currently do see 10-year yields rising towards the 2.8 to 3.05 later in 2019. We noted that recently Morgan Stanley also changed their year-end target to 2.8%. All this is based on the fact that the U.S. debt is increasing at such a rate, and there's a shortage of buying coming from Japan and China, and of course the whole movement to de-dollarization. I need to add that neither of us are in the mainstream on this outlook. A boundary condition ratio that has helped us significantly over the years is the SPX to TNX ratio plotted on a log scale. We see yet another head and shoulders here within a clearly emerging domed top. The ratio suggests for this to occur, we need to see yields fall a little further while equities continue to strengthen a little further, at least in the short to intermediate term in 2019. We see this to be the case in the 10-year U.S. Treasury, but what about equities? This is another chart you have seen many times as it has unfolded. As you no doubt recall, we called the bounce to the right shoulder, shown here, prior to the bottom reversal, shown at the bottom of the chart. Though we called for a W bottom versus a V bottom, we are fairly accurate on the level we would reach to achieve our forecasted right shoulder. We took less time than we predicted and also broke the black trend line, which we initially felt would contain the lift. We're watching closely to see whether the dotted red line holds, giving us a double top, or whether we lift higher than originally anticipated towards the labeled convergence shown by the question mark. Concerns this week with an impasse on the Chinese trade agreement may trigger a near-term consolidation around some of our Phi and Bradley turn dates before we head higher when a deal is again rumored to be once again on track. When an actual deal is reached, we are then likely to see a buy on the rumor, sell on the news event. Shown here is the Dow Jones Industrial Average ETF, or the DIA chart. We have also had in place since early 2018. The right shoulder is higher in the Dow Jones Industrial Average, being a slightly different pattern than the S&P 500. Time will tell, but you can see why we called 2019 in late 2018 as the year of the right shoulder, and that appears to have been a great call, at least so far, as clearly some of the averages are showing right now that a double top may be in the works. Another chart to watch is credit, as represented by high-yield bonds, which we show here as the JNK, or junk, for the higher credit risk junk bonds. The year-end reversal has been absolutely dramatic. Money has poured back into this higher yield area. The as yet unfilled gaps is something we were watching closely and troubled us when they weren't filled when the high yield market appeared to be crashing. A little more strength and we would now satisfy this chart. All in all, looking across the intra-market charts, we have a pretty strong case of evidence for a possible right shoulder correlation. We talked about valuations last month. 6 companies represent 37% of all the S&P 500's value creation over the last 5 years. Amazon at 10.1%, all the way down to Netflix. The U.S. stock market, or at least the S&P 500, is inextricably tied to the present and future of disruptive technology. Over a third of the S&P's 44% value accretion in the last 5 years comes down to a handful of now super technology disruptors. Without them, the S&P's total value would only have compounded annually at about 5% instead of 7.6%. Disruption at a global scale can add as much market value as a much larger but old school business, even if the latter is very well run. What will be the source of the S&P's value creation over the next 5 years? I.e., where is the next 3 to 5 trillion of market cap going to come from? Here's how we handicap the odds. About 65% say that it will be the same companies. They will have the scale and scope to develop the next wave of disruptive technologies and get them to market. U.S. equity valuations reflect present and future technology disruptions. That's our conclusion. The salient point from the Q1 earnings season is that the results have not been bad enough to stop the U.S. stock market from getting back to an all-time high. Companies that disappointed were strongly punished. Google's parent Alphabet, the latest and most spectacular example, while those that won the game of massaging expectations gained little reward. Companies that missed on both their earnings and sales were punished with a 5.9% decline in their shares on average. Those that managed a positive surprise on both measures gained only 1.7%. The S&P 500 margins are coming in narrower than they did in the same quarter of last year, and that is the first time this has been true for some years. Narrower margins are afflicting virtually every industrial sector. Many companies are complaining about higher costs. This picture could be consistent with a broad rise in labor costs eating into margins. Revenues have not beaten expectations as much as they usually do, but overall they still show little or no sign of a global downturn in at least the Q1 earnings. Where once they could not bring themselves to recommend a sell, that is the Wall Street analysts, now it appears they cannot stomach the notion of predicting that earnings per share could possibly go down. We are again seeing a hockey stick in late 2019. I've never seen one of these hockey sticks in terms of Q4 results ever materializing. We do a lot of cycle work, as you're well aware, at mattasii.com, as it is a critical element in developing our strategic investment insights, or SIIs, and their associated watch lists. What few fully appreciate and is critical to cycle timing is that, one, contrary to popular belief, a deceleration of GDP growth is a very bullish development for U.S. equities at this stage of the U.S. business cycle. 2, slower GDP growth will tend to extend the probable length of the current U.S. economic expansion and the U.S. equity bull market. And 3, the optimal range of GDP growth for U.S. financial markets at this stage of the U.S. business cycle is probably about 1 to 2%. A recent article that I saw on Seeking Alpha, and I quote James Kostrowski, who wrote it, is, and I quote, "At this particular stage of the U.S. business cycle, below trend GDP growth of 1 to 2%, to the extent that it stabilizes within this range, will actually maximize the length of the current economic expansion and will most probably increase the length and intensity of the current bull market in U.S. equities. This is one of the most important references that should be drawn from the recent GDP report. The inflation data released in this same report have even greater bullish implications. End of quote. I think this supports our original 3 points. We show here the U.S. business cycle and the strategic window of favorable conditions for the U.S. equities for your perusal. I'm becoming increasingly concerned about flows and liquidity. I always am, but they only seem to be getting worse. The Fed's sustained QT measures are still occurring, and the cumulative effect is now reverberating through the financial markets. Money supply as a primary driver of the market has recently begun to diverge from the equity markets. It appears that the brief rebound in domestic U.S. money supply growth, triggered by repatriation of funds from the euro-dollar market in the wake of last year's tax cuts, has now been dissipated. Preliminary data indicate that the slowdown in the TMS2 growth continues so far in April. Currently, the year-over-year growth rate stands at just shy of 1.7%. The continuing slowdown in money supply growth represents a palpable threat to the bubble in asset prices. Separately, in our view, there are 3 reasons that the global FDI flows are falling, that is, foreign direct investment. One is one-time events, which everyone quickly acknowledges as the reason, but the other 2 are structural. The first is the obvious one. The 2017 change to the U.S. tax incentives for foreign repatriation of large amounts of earnings held with foreign affiliates took shape. 2, less understood, is slowing global trade and economic growth. And 3, the slowing rate of growth in financial leverage due to the availability of unencumbered collateral and its associated shortage. The AAI Investor Sentiment Survey shows that the neutral sentiment saw a sharp decline, falling to 39.6% from 46.3%. That is the largest decline since the final week of 2018, when the market bottomed and a very large portion of investors reported outright bearish sentiment. This time around, the decline in neutral sentiment predominantly went towards the bulls. The percentage of investors reporting an optimistic outlook rose slightly to 39% from 33.5%. This is only modestly above the historical average. Bearish sentiment also rose 1.2% to 21.3% this week. In a grand scheme of things, though, even with this increase, bearish sentiment still remains at very low levels. The surge once again in shorting volatility tells us how, once again, the Fed has instilled unprecedented levels of market complacency. Last time we saw this, it resulted in violent market reactions in February of 2018 with a dramatic single one-day 1,000-point Dow shocker, as many of you will recall. Small business are often said to be the backbone of the U.S. economy. Many small business owners have already begun their own preparations for the next financial downturn. Maybe they know something we aren't being told by the mainstream media. According to a new survey by the Bank of America Corporation, small business owners across the United States are bracing for the next recession. More than 2/3 of small business owners surveyed by the bank said that they have taken steps already to prepare for an economic downturn. What is it their numbers are showing them to start worrying now? Usually they don't worry in advance. We have built market bubbles based on false assumptions that have consequences. Accelerating de-dollarization will soon be the grim reaper of reality. The coming black swan is de-dollarization. There are 2 major false assumptions. The 1999 repeal of the Glass-Steagall Act of 1933 was in the best interest of the American economy and its citizens through the increased investment of borrowed money. Remember, this is a false assumption. What was put aside is the fact that the original act was intended to assure that banks would never again recklessly create loans to the public that could never been repaid. And what have we seen since early 1998? The repeal ushered in a period of reckless loans and mammoth debt bubble. The second false assumption is that quantitative easing pumped money back into a failing economy. In fact, it did not. Most of the money that was created through quantitative easing never actually hit the streets. It was simply gobbled up by the banks. The pretense was that quantitative easing would be used to pay off bad loans, re-energizing the economy. Interestingly, enough money was pumped into the banks through QE 1, 2, and 3 to literally write off every mortgage in the country. Had that been done, those cleared of debt would indeed have had the ability to reinvest in the economy. The consequences of all this: a greater depression, a debt bubble, and a slowing velocity of money. We won't get into it here. All that's required to eliminate the notion and to send the company into tailspin is a black swan event associated with de-dollarization. Will it be the dumping of treasuries back into the U.S. system, as is now on the increase? Will it be the full implementation of the Chinese interbank payment system in lieu of the American-based SWIFT system? Will it be the elimination of the dollar as the petrodollar, as is now underway? And more. It is slowly and insidiously happening, like a glacier that nobody notices but is moving. At some point, we will notice, and the market will react. That will be the black swan in my mind. One investor has a history of timing major market turns like no other. He called the 2011 growth peak before anyone else. He nailed the 2016 bottom in risk assets, and he even timed the December bottom perfectly. His name is Dr. Copper. Copper hit its peak right at the top of the 2011 growth inflation cycle. It also caught the bottom of the deflationary drop in January 2016, and it also peaked during the synchronized growth cycle of late 2018. However, since that time, copper has struggled. The industrial metal has tried repeatedly to mount a sustained rally, but cannot break out over its long-term critical resistance. Additionally, we have talked a number of times about the disconnect between the equity markets and the bond markets. Given what copper and bonds are saying, stocks are in for a very rude surprise at some point, because these markets have proven track record of calling global growth. Meat costs are finally going up, and that's weighing on the dining industry that's already reeling from rising minimum wages. This is saying something about inflation that's coming and what this will mean to the bond market. McDonald's Corporation warned investors here this last week its 2019 commodity costs in the U.S. could rise as much as 3%, more than the 1 to 2% inflation it had forecast just 3 months ago. Some of our SII watch list members, such as BJ Restaurants, it's a brewhouse chain, last week said it's expecting increases in pork prices. Texas Roadhouse, another MATA SI watch list, an American chain specializing in steaks, higher prices are now on their menus, with customers paying as much as 3% more as it tries to offset rising costs. That's going to go a long ways on their margin, according to the president. For example, Kentucky Fried Chicken in China said its spiking poultry costs will weigh down margins for the rest of the year. We're seeing that right across the board in terms of meat products and some of the other food products in the restaurant industry, another part of our SII watch list. We have talked extensively in prior months about the forced inflation occurring in domestic services versus global and manufactured goods. There's no question that inflation is on the horizon. Last month, I focused on 2019 being the year of the right shoulder. In that context, let's have a look at some patterns that show we are being overrun by ending diagonals that's signaling the achievement of this right shoulder or double tops, depending on the index. Here we have the overall market as represented by the Wilshire 5000. It appears to have broken its wedge, and we may expect an underside test before heading lower. Here, our SPX, which we showed earlier, shows an ending diagonal having completed a double top. Here, the NASDAQ also shows the completion of an ending diagonal. The Dow Jones Industrial Average shows the completion of the right shoulder of a head and shoulders with some open gaps that need to be filled. These charts don't mean we will not see new higher highs. What they do, however, tell us that we are soon going to see a corrective consolidation at lower levels. How low and how fast will tell us something about the ongoing trend to the upside, if in fact it's over, or the degree to which we can see it rising. On a separate subject, our Strategic Investment Insights watch lists of over 150 securities give us some interesting observations that we don't see covered in the mainstream media. We have seen increasing interest in precious metals, which, as you can see on the right side, has delivered some strong returns, whether short or long. We're not saying precious metals are about to take off, but rather the manipulation of paper, gold, going on has increased the volatility of some of the key deliverers of gold and silver. Our technicals are keeping us on the right side of the long-short positioning, at least so far. We are also seeing changing market thinking and behavior. We don't have time to delve into them in detail, but let me say a couple of words on each and save the detail for future long waves. The rise of zombie and unicorn is further proof that the markets have disconnected from fundamentals. We've talked about this many times. But the hot players, not too dissimilar prior to the dot-com bubble bursting, are being valued differently. Recent IPOs like Uber and Lyft are quite clear in their perspectives that profit, both in the short and long term, are serious concerns. In fact, they won't even commit to that happening. Like Amazon and Tesla, it doesn't seem to matter to investors. They and others are being valued on the basis of the degree of their disruptive technologies, the damage they will do rather than the money they will actually make. Is it a matter of hope that they will find a way to eventually make money? I don't know. Or will it be those trying to protect their established business models and profit modes will be then forced to take them out and blend into some sort of new business models? Time will tell, but the money is certainly flowing into areas that are not based on the fundamentals. We are continuously seeing short squeezes, which is typical of bear market counter rallies. This time, however, it is by sector. For example, we recently reported that we had an outsized upward movement in our auto sector, which was heavily shorted. There was no news, just this wave of targeted buying forcing covering, then, just as quickly, exiting the particular sector. This is an example of really customization of what we typically see in bear markets, where we're getting it right down to specific sectors, groups, and instruments that are shorted and using it to drive the market or drive at least returns. I suspect that the plunge protection team is operating behind the scenes in this regard to get the biggest bang for their buck in stabilizing the market. We are once again seeing through various measures such as complacency that the Fed is trapped and has instilled in the markets once again the belief that the central banks have investors' backs. Japan's outright and blatant, what I will call nationalization of the markets, heeds further evidence to this belief. There is heavy evidence that the central banks will soon be forced to cut rates, bring in a new form of quantitative easing, likely called QE for the people, and then head towards NIRP. That is, negative interest rates. The market seems to be acting as though this is a given. We see that the plunge protection team has once again been activated. This was blatant on Monday when the Dow was down 500 points in the pre-market, but buying arrived at the U.S. Open. Secretary Mnuchin was rumored to be working the plunge protection team behind the scenes. Our proprietary PPT measure from days gone by shows us this was clearly the case. The vol complex, or volatility area, is showing we may be on the verge of another VIX-mageddon, like that last seen in early February 2018. As I said, I just wanted to share some observations in closing without delving into them further. Pay particular attention to our key dates, which we just updated. We have a FI date on May 8th and a Bradley turn date on May 16th. These are plus or minus a couple days. It is time for consolidation, which we have not had since the historic rally kicked off from the 2018 year-end market lows and the Mnuchin massacre. As you are fully aware, I always end with a reminder that they will print the money to solve these and all problems. It is the only answer politicians will ever agree on. As these two charts show, both China and Japan already have and continue to do this. When the Bank of Japan estimated aggregate ETF balance totals 29 trillion yen, about $250 billion, you know it is only a matter of time before other central banks are forced, or at least will, follow suit. They will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will be forced to react. Your chances of making money go up significantly. I'd like to take a moment as a reminder, do not trade from any of these slides. This work is for educational and discussion purposes only. Thank you for listening, and until next month, may 2019 be an outstanding investment year for you and your family. I sincerely thank you for listening.